OK, we're going to break into US programming. We're now going to count down to live coverage of Chancellor George Osborne's autumn statement from Westminster. Joining us in the studio to discuss the statement, Tom Cloherty, the Executive Director at the Adam Smith Institute, Adam Marshall, the Director of Policy at the British Chambers of Commerce, and Ruth Lee, an economic advisor even at Arbuthnot Banking Group. Well, look, welcome to you all. I suppose the key thing, Ruth, here is so much has been leaked in the press today from George Osborne. I suppose maybe the most important thing is what the OBR releases and what he says the OBR's new projections are going to be. The OECD thinks we're going to be in recession. I know Adam's group, the British Chambers of Commerce, believe we won't be. What do you think the OBR are going to say?
Well, I don't know if they'll actually talk about recession, or they will give the quarterly growth figures for the next couple of years, so we'll see if they've actually got negative figures in there. But even if they don't go for a technical recession of 2 consecutive quarters of falling output, they're going to go for presumably very, very weak growth for next year. We know it's going to be about 1% or perhaps a little bit less than that for this year, even if you've got some growth in the fourth quarter. But going forward, of course, the expectation is that they might come in for 1% growth or possibly even 0.5% growth. And then what will be very interesting is what they do after that into the medium term, and whether they actually cut down on their potential growth rates, because they've got implicit in there is a 2% productivity rise. We haven't had anything like 2% productivity rise. If they down that as well, then you could see the whole growth profile being pushed down, and I think that's what I'm going to be looking out for.
Adam?
Well, our forecast for 2012 is still narrowly in positive territory. We're looking at the first 2 quarters at about 0.1, 0.2% growth for the UK economy. We are hopeful that we're able to maintain that weak level of growth and then see it accelerate later on in the year. And then we'll go up to about 1.8%, we believe, in 2013. So it's not the greatest of news, of course. We know the fourth quarter this year will be bad and the first 2 quarters of next year will be tough. But we don't think it's all doom and gloom. And when I'm out and about in the real economy meeting with small and medium-sized businesses, funnily enough, there is some underlying confidence there.
How much pressure will those downgraded forecasts political pressure put on George Osborne, Tom?
Well, I think it's largely a political question. I mean, we're all accepting, I think, that the growth figures aren't going to be good, whether it's a slightly technical recession or whether it's just stagnant growth rates for the next couple of years. In the grand scheme of things, the impact of that is not that large. What it does mean, what is huge, is the political implications of it. Because George Osborne has always said, you know, that we're cutting public spending, this will allow us to keep interest rates low, and that will allow us to promote growth. Now, as you know, I've been hugely in favour of the spending cuts. I think there should have been much deeper spending cuts, in fact. But I've always thought that logic was faulty, that just by keeping spending low, by keeping interest rates low, growth would come. I think it's a far too credit-centric view of how the economy actually works. And I think the big question is going to be whether George Osborne sort of moves away from that, whether he's pressured by Ed Balls, by the Labour benches, into some move in his overall position and his overall strategy. Now, I don't think that that's likely to happen. I think we're going to hear a lot of sound and fury. I think it's going to be worryingly reminiscent of Gordon Brown, actually. Lots of micro-policies.
Does it help him? How much does it help him that going into this statement, gilts this morning are yielding less than bunds? He's bound to use that, isn't he?
I'm sure he is. He almost always starts these statements, you know, pre-budget report, budget statement, comprehensive spending review, by drawing comparisons between Britain and comparator economies around the world. And yes, he's very proud of the fact that our gilts are yielding lower than the bunds.
The question is, Ruth, is whether actually that's down to UK policy or not.
To both, I think, in the sense that what's happening in Germany is that their yields have gone up quite a bit because there's been this flight, even out of the core Eurozone countries, as the crisis has gone on in the Eurozone. And by the way, there's a meeting today, I think it's the European finance ministers meeting today of the Eurozone. In a curious way, that's much more important than what's happening with the autumn statement. But so there are problems in the Eurozone, even in core Eurozone, even in Germany. But here, of course, it's not just that the markets are prepared to accept the credibility of what Osborne's doing with the finances, and give him credit for that, but don't let's forget there's something being called quantitative easing. There's already 200 billion of gilts bought, another 75 billion. People are talking about another 200 billion.
The OECD said 400 billion, which is, Mark Oswald from Monument Securities told me yesterday, would be half the conventional gilt market, which would destroy the gilt market. Seems to me like a crazy idea. But
well, I don't know if it's a destroy, but it certainly makes it makes it look very different from what it otherwise would be. So let's be honest about this. I think a lot of our low yields are partly manufactured by the QE. And in fact, that was one of the reasons for doing it. Let's be honest about this. So a bit of both, I think.
OK. Right, let's just show you what's going on. William Hague at the moment is just speaking in the debate ahead of the autumn statement. He's inside the Houses of Parliament. Outside, our man on the ground is Steve. So, Steve, look, a lot of this has already been leaked. What are you going to be focusing on?
Well, I think one thing I just want to contribute to the previous conversation is the fact that we're going to get three things from the OBR today, we believe. One, of course, is going to be those dismal growth outlook figures. Two is the fact that our borrowing over the lifetime of this Parliament is going to be significantly higher than we expected. But the third thing, actually, is perhaps mildly positive because, of course, as your guest was saying, we have these very low gilt yields at the moment. Actually, the OBR's estimate from back in March was based upon a 3.8% 10-year yield. And, of course, now we're trading somewhere in the region of 2.3%. So that does leave a multi-billion-pound saving over the lifetime of the Parliament, which goes slightly, if indeed we keep these yields low, slightly to offsetting the negativity and lack of tax receipts we get from those lower growth figures as well. But in terms of what the government can offer and the Chancellor of the Exchequer can offer today, well, he can't offer that much, can he? It has to be what's called fiscally neutral, i.e. he can't give too much more in case the gilt markets believe there's some form of slippage and those yields start picking up, and he really can't afford to go any tighter in case there's even more economic demise and we have a sharper recession than those quite mild figures that the OECD talked about. So what measures can we expect? Well, one, we're going to get just a slight rising of that bank levy to pay for some of the initiatives that are going to come through today, to keep the bank levy at somewhere in the region of £2.5 billion sterling. We're going to get some form of incentive for the banks to lend to small and medium-sized businesses, with the government talking about potentially indemnifying the banks against losses on some of those loans, somewhere in the region of 20 to 40 billion pounds. Two sets of figures have been talked about. Infrastructure spending, encouraging the likes of those sovereign wealth funds out of China, the pension funds in the UK, to get some form of incentive to invest in UK infrastructure and create more jobs. And on the jobs front as well, of course, we have pretty awful youth unemployment in this country. Perhaps incentives as well to get some of the employers out there employing youth and indeed younger workers, and so to get that huge figure down, because of course there's a huge number in parts of the country where we just don't have working youth employment. Energy initiatives as well could come in there, as I say, more infrastructure initiatives, and pretty much that's all he can offer, because as I say, this is going to be a fiscally neutral set of policies today, Ross.
Yeah, Steve, stay with us. Let's just bring in Adam Marsh from the British Chambers of Commerce and some of those. This idea that he's going to underwrite £20 billion of loans through banks, small and medium-sized companies, and bring around 40 large infrastructure projects, new railways, roads, that sort of thing. Are you in favour of that? Can he utilise Britain's cheap borrowing at the moment to the benefit of these projects?
Well, I think we can be positive about both credit easing and the infrastructure announcements up to a point. On credit easing, for example, we think that it could help get credit through to some viable small and medium-sized businesses. However, the transmission mechanism here is still the banks. So, of course, there's a breakdown of trust, of communication between lots of small and medium-sized businesses and the banks, and we actually have to put that communication issue right almost before we start to try to boost up lending if business demand requires it. On the infrastructure side, there's only about £5 billion of government money actually being put forward here. What they're actually doing is they're going to the pension funds, hat in hand, and saying, please, can you contribute to investment in UK infrastructure here? Now, this is something I've been looking at for about 10 years. It's always ended up in the too difficult pile at the Treasury.
So how do they crack it this time? How do they get the pension funds?
That's a very good question. What I'm interested to hear from the Chancellor today is exactly how UK pension funds, and remember, there are not very many big UK pension funds to make these investments, unlike in countries like Canada and Australia. So I'm very interested to see how this £20 billion will be magically unlocked.
How do you think they do?
Well, I think I buy that. And as for the credit easing, I'd just like to read out a little bit of the Financial Times' comment on it this morning. Ministers have no idea whether this will work. I mean, if they don't know, do we know? But I would say that I'm not against this in principle, because there is a problem with the banks and there is a problem with bank lending to small businesses. Because as the banks are being squeezed and being forced to hold more and more capital, it means they have less money for lending, not least of all small businesses. And I think a recent ONS survey showed that, in fact, small businesses were increasingly finding it difficult to get money from the banks.
Well, but it's interesting, this morning we had M4 numbers out. Bank lending, M4 lending, excluding the effect of securitisations, fell fell by 1% month in October. And I think the annual fall was the biggest on record, which basically shows us, doesn't it, that the banking sector is still a significant constraint on the economic recovery.
Absolutely. And as I say, the problem is, from a banking perspective, we're asked to just hold more and more capital, which of course restricts the amount we can actually lend. And with Basel III round the corner and all these other implications for banks, you can see that this is going to happen for some time.
Tom, actually, is this credit easing plan actually a political acknowledgement that we can't get the banks? However much we pretend to keep asking them to lend, we actually can't do it.
You know, I think that it probably is, and yeah, there are huge problems with bank regulation. Yes, the banks are not acting as an effective funnel to small businesses. Certainly, credit conditions are tight for a lot of businesses. I don't doubt for a second that under the credit easing scheme, some viable businesses will get the funding that they need. I also don't doubt that a lot of businesses who wouldn't get funding in a real market will. And I also don't doubt that when interest rates go up, as they surely will at some point, some of those businesses might run into trouble. And I think we're in serious danger of replaying the whole problem we had with the subprime crisis in the US. This is very much like Fannie Mae, Freddie Mac for small businesses, packaging up loans, selling them on as derivatives. Ruth said she's not against this in principle. I am against this in principle. We have a banking problem. Let's accept that. Let's deal with it. Let's not do more of the things that caused the problem in the first place. I think the government getting involved in the allocation of credit is a very dangerous thing.
Adam disagrees. We'll get his views. We'll get his views on that in just a second, because he thinks small businesses need all the help they can get. Steve.
Yeah, absolutely. I mean, again, just I want to come back to this this gilt argument, if I may. A lot of people are actually disputing whether it's the government plan that is leading to these low yields, whether it is actually the lack of alternative on the yield front as well, or if it's just really simply down to the fact that it's QE, that the Bank of England is buying in such large quantities, and whether actually it's the monetary policy that's keeping the walls from the door for the UK economy at the moment, because, as we've said, the slippage on the plan is going to be at least 2 years and taking us back down to 2017, which is well into the life of the next parliament. There are real concerns that actually, if we continue to see a breakup of what's going on in the Eurozone and the carry on of the demise there, and a lot of central countries now finding their yields going up, the French, the Belgians as well, and even the Germans, there is concern actually that even the Bank of England QE policy and indeed the sticking to austerity in the UK just will not be enough.
On the international scene, I think it's ironic. Here we are with an 8% to GDP deficit of, what, 120, 130 billion this year, with debt rising very quickly, and yet we're a safe haven. And the other great haven is, of course, the United States of America, where its debt to GDP ratio is about 90%. It's extraordinary. But that tells you, as I was sort of implying earlier, what absolute crisis we've got in the Eurozone, and that really is where all the news is at the moment.
Is it right to blame the entire change in what the OBR is going to say on the Eurozone, Tom? I mean, that's the political. It's politically easy to say. Yeah. Look, we're changing our forecast because of the Eurozone crisis.
Okay, is the Eurozone crisis a problem for the British economy? Yes, of course. Is that the only reason that the OBR isn't meeting their original growth forecasts? Absolutely not. I think I've said, and other guests said when we've done these things before, their growth forecasts were absurdly optimistic. There was never any way we were going to be meeting
The Chancellor is now standing up. Let's turn into what he has to say.
He starts by